Okay guys, we will take up India 37, standard on provisions, contingent liabilities and contingent asset. Very simple standard, but this standard ka beauty is based on the definitions of the standard. Let's see. A provision is defined as a liability of uncertain amount or timing. There should be uncertainty in the amount of the liability or when you are going to settle it. So a liability with uncertainty is called as provision. Fine. Come to liability definition. Liability is defined as a present obligation arising as a result of past event. Obligation means what? A duty. Our duty is existing, therefore we call it as present obligation, and since it is existing, you have to settle that obligation. For settling that obligation, it results into outflow of resources. So there is a present obligation arising as a result of some past event. The settlement of this obligation will result into outflow of resources. Some asset outflow is required to clear this obligation, then this obligation is defined as a liability. Next. Obligation means what? Obligation means a duty or a responsibility. Sir, why will you have an obligation? There are two reasons. One is legal obligation, one is constructive obligation. Legal obligation means, for example, there is by act of law, obligation is there. If you don't fulfill this obligation, legal consequences will be there for you. You are a resident in India, you earned tax. You have to pay tax. Sir, when did I enter into a contract, sir? Did I enter into contract with the auntie that I'll pay tax? Sir? No, but she will take tax from me. Law, legal obligation. Next, I sold goods with warranty. I told that any fault in the goods, in the next 2 years, I will repair freely. Did you commit that at the time of sale? Yes. Somebody brought the goods with defect. You says, I won't repair. Can he file a case on you? Legal consequences will follow. These are called as legal obligations. Next, constructive obligation. Constructive obligation means legally obligation does not exist, but you have self-imposed some obligations on yourself. Constructive obligation means a self-created obligations. Example, I'm doing business in a particular area since last 10 years. I'm a very honest man and all. So I sell goods. If any customer does not like my goods and returns that goods within a reasonable time period, unused, good condition, I will happily accept the goods. Sorry sir for your disappointment, and I will give them full refund. This has been my practice since last 10-15 years in the market. But at the time of sale, I never promised the customer that I will accept refund of goods. I never promised that. Neither it is written anywhere. But it has been my practice. Now, on the balance sheet date, last 1 month I sold 100 units. My past experience tells me that out of this 100 units, roughly 5 units are going to come back for refund. When 5 units are going to come back for refund, tell me, ask yourself, will I pay this or not? Will I pay refund or not? Yes. Am I legally required to do so? No. But still I am going to pay or not? Yes. Why? Because of your past practice, because of your desire to maintain good relation with the customers, because of your business practices, because of customs in the business, because to fulfill the expectation of the other party. These are called as constructive obligations. So for creating a provision, legal obligation is not required. Constructive obligation is enough. Important, sir. Next. In the definition of liability, we came across a term called as present obligation. Now, what is present obligation and what is possible obligation? Listen, sir. Present obligation, what context you have to understand is, in school, when you go to the classroom, they'll take attendance. They call out your name or roll number. Say present, sir. That means what? You are existing. Like that, present obligation ka meaning is you have to prove that obligation is existing with a chance of more than 50%. With a chance of more than 50%. So, for example, I took a loan from a bank. Next day only, I went to the bank. Bank, do I owe money? Bank says, yes, yesterday only I gave you 100 crores. No, correct. What is the chance of I owing you money? That fellow will first slap you and they say 100%. Is there an uncertainty? I borrowed money, I have to pay. No, obligation is there. 100%. I purchased goods on credit from you. Okay. After 2 days I come to you, do I owe you money? Yes, sir. Yes. What is the chance of I owing you money? 100%. Sir, when anyway it's 100%, why do you do overaction more than 50%? Listen, these two are clear-cut liabilities. But there may be scenarios where existence may be uncertain. When existence is uncertain, the standard says still it is existing only if the chance of existence is more than 50%. Example. Somebody filed a case on me saying that my goods are not functioning as described at the time of sale. So that fellow sends me a damage notice of 15 lakh rupees. The moment he sends me a damages notice, I am the owner of my company. Will I think, should I create a provision or not? That's my thinking. No. My thinking will be what? Should I pay this or not? Who will bother about creating provision? Accountant fellow will bother. I am not accountant. No, I am owner. When somebody sues me for money, will I bother about what will be my accounting impact? That is my worry. No. I will only bother about whether I have to pay or not. How will I decide? I will ask my technical team. Why is the product, whatever is complaining, is it true or not? Then I will bring legal team of people. Everybody will sit. Ultimately, we will make a internal assessment. What is the status? If we go and fight this in the court of law, whether we will win or lose. In case if we lose, how much we are likely to pay? What is the chance of losing? This kind of discussion will happen. Nobody will bother about will I write P&L to provision or will I disclose? Will anybody discuss accounting, sir, when I have to pay money there? So in this internal assessment, if you conclude that there is more than 50% chance that obligation is existing, then this obligation is called as a present obligation. Here 100% less, more than 50 is enough. Lawyer told, sir, 70% you have to pay, sir. 30% God willing we may win. But 70% likely you have to pay. Khatam, present obligation. If the lawyer says, sir, only 35% chance, 65% chance that we will win the case. But 35% chance that we may lose. 35 is not exceeding 50, no. Therefore, it is not a present obligation. It will be called as a possible obligation. But remember, once you are not a present obligation, you are not a liability. And once you are not a liability, you will not become a provision. So if you have to become a provision, you should first become a liability. And if you have to become a liability, first you should be a present obligation. And if you have to be a present obligation, you should have a chance of more than 50% of existence of the obligation. It's all linked like that. Clear? Now, recognition criteria for provision. Now, what is the entry for any provision normally? P&L account debit to provision. Provision for warranty, provision for damages, provision for litigation expenses, all this P&L to provision. The moment you write this entry, this is called as recognition of provision. Recognition of provision. Standard says, just because you are debiting your P&L account, you cannot write this entry whenever you want. If you want to write this entry, 3 conditions you have to fulfill. Condition number 1. There should be a present obligation arising as a result of past event. Which means we are talking about existence probability crossing how much? 50%. Next. It is probable that outflow of resources is required to settle the obligation. Just because obligation is existing, that is not sufficient. Outflow also should be probable. That means what? Chance of I paying also should be more than 50%. And if you have to write the entry amount, you should have no. Therefore, a reliable estimate could be made towards the amount of obligation. If 3 points are satisfied, then only you can record this entry. Otherwise, the entry you cannot write. If you observe, these 3 points are nothing but definition. Present obligation is definition of liability. Outflow of resources is also definition of liability. What is provision definition? Provision is a liability with uncertain amount or timing. Since there is an uncertainty, you should be able to reliably estimate and measure the amount of obligation. Therefore, 3rd point is given to you. Now, if I summarize this, one is present obligation, one is probable outflow of resources, and 3rd one, a reliable estimate. If all the 3 points are satisfied, then only you will create a provision. Sir, what if First point, happily failed off. There is no present obligation. You have to go deeper, ma. Present obligation not there means what? Chance of existence is not exceeding 50%. That means what? It is less than or equal to 50%. That case is called as what we discussed already. It's called as a possible obligation. But chance of outflow is there. Reliable estimate also can be made, but obligation ka existence a doubt. This is one case possible. Provision you will not create, don't worry. Other case is present obligation is there. Liability ka existence I am confident, but I am also confident that outflow will not be there. Why sir? Law is weak. I jumped signal today morning only while coming to class. The moment I jumped red signal, I know I violated law. Do you think after coming to the class I will write entry? In my cash budget, okay, penalty will 1000 rupees challan I will write. No. Because last 10 times I broke signal, only 3 times I was caught. That means what? 70% of the times I was not charged anything. Only 30% I was caught. So today morning I jumped signal again. Habitual offender. So what is the chance of my outflow? 30%. 30% probable outflow. No, gone. Second point failed. Estimate. I know penalty amount 1000 rupees. Still no provision. These two satisfied. I committed something first of its own kind. For that penalty are not there anywhere. Court has to decide. And nobody is unable to estimate. So I will play tic-tac too. Anyway, first case provision. These 3 cases, you cannot create a provision, but this will satisfy the definition of contingent liability. Idhe contingent liability definition, there is no other definition. You know how contingent liability is defined? Contingent liability, 2 parts are there. First part, contingent liability is a possible obligation, the existence of which will be confirmed by occurrence or non-occurrence of one or more uncertain future events which are not wholly within the control of the enterprise. Somebody filed a case on me, lawyer says 30% chance, but still it is possible, no? Whether it will be there or not, who will confirm? Court judgment will confirm in a future date. Is it under my control? No. So possible obligations are contingent liability. Point number 1. Point number 2. Contingent liability is a present obligation. Present obligation, why did you not create a provision? Because either outflow of resources is not probable or a reliable estimate could not be made. This is the definition of contingent liability. Last 3 boxes, last 3 columns. That's what we have given here. Provision, you will record an entry. Contingent liability, there is no accounting. You will simply have to give a disclosure in the notes to accounts. Unless, but this also exception is there, sir. The possibility of outflow is remote. Chance of outflow is extremely low. Don't even disclose it. What happens is, bigger companies, daily somebody or the other fellow will be filing on cases. Random stupid cases they will file. Sometimes the company may come down for settlement and pay some amount. There are so many jobless people outside. All that cases, if I go on displaying in my notes accounts will become telephone directory. So standard says if the outflow is very remote, don't even disclose it. Next, contingent asset. For a change this time, I filed a case on somebody seeking damages. I am Nike. I am Nike company. Somebody copied my logo with a small bend here, and I am selling caps, sports gear and all at 80% lesser price. I am selling each cap at 1,999. That fellow is selling for 99 with the same thing, same glow, almost the same. I filed a case on that. Matter is pending in court. Can I recognize an asset? Receivable can I recognize? I am having very high chance of winning. Contingent liability which you have to pay, that only standard asked not to recognize. Contingent asset, why will they allow you to recognize? Contingent liability I am disclosing. Contingent asset also you will only have to disclose, provided winning the case and recovering that amount is probable. If that is also not probable, don't even disclose it. Sir, then when will you recognize it? Whenever receipt is certain. But when receipt is certain, it is no more a contingent asset. So that's why you should not make any statements like recognize contingent asset when it is virtually certain. A statement itself is self-defeating. When something is virtually certain, it won't be a contingent asset anymore. No. So don't recognize anything, simply you have to give a disclosure. Now coming to measurement of obligation, that is provision if you have to record an entry, or contingent liability if you have to give a disclosure. Amount how to measure, standard is giving you guidance. Simple sir, very easy. It says that consider the best estimate, latest estimate on every balance sheet date, considering your internal information, report from experts, survey reports, recent judgment of courts in other similar cases, factor everything and then arrive at a best judgment. Then in this one case is there, suppose there are class of obligations. There are multiple obligations which are of similar nature. Classic example for this is warranty. I have sold 1000 units in the last 1 year. I believe that out of this 1000 units, 5% goods will come back for repairs. This is an estimate. When they come for repair, what kind of repair? 1. Minor, normal, major. 3 kind of damages are possible. If it is a minor repair, I have to incur only 1000 rupees to repair this. Normal repair, I have to incur 2000. Major repair, I have to incur 5000. So there are multiple possibilities of amounts. The standard says in this case you will apply expected value approach. Expected value approach means what, sir? Portfolio management, statistics, probability you take, marry them, get an average figure and measure it. So based on your past experience, what is the chance of minor repair? Let us say you tell me 30%. Chance of major repair 50%. Chance of normal repair 50%, major repair 20%. If these are the probabilities, marry them. So this is 300, this is 1000, this is 1000. Total 2300 per unit. Total how many units? 50 units. So 50 units into 2300. Some number you will get. How much you will get? 1,50,000, na? Go and create a provision for this. When will you do? When there are class of obligations and there are more than 2 amounts with probabilities, then only you should do this. Otherwise you should not do this. Sir, you should not misunderstand that on every unit I will go and incur 2300. Not like that. The average number. If 50 units low, on some units I will incur 1000, on some units I will incur 2000, on some units I will incur 5000, but overall it will be equal to 1,50,000, which average number I am multiplying it. Yep, this is one thing. Suppose there is a single obligation. Suppose income tax fellow filed a case on me, matter is pending in appellate authority. Now there are 2 possibilities. They are asking for 100 crores tax payment. We are fighting the case, but in case we win the case also, if we win the case we have to pay only 20 crores. If we lose the case we have to pay 100 crores. Only 2 possibilities. Single case, not class of obligations at all. Now coming to probabilities, the chance of I losing is 90%. The chance of I winning 10%. You should not go with expected value method. You should go with most likely outcome. What is most likely outcome? The one with higher probability. This one. You will create a provision or disclose a contingent liability for 100 crore rupees, whichever is higher probability. What will you do if it is 50-50? Tell. If it is 50-50, what will you do? No. This is not probability of existence. No. Existence of probability is not a present obligation. Even if it is not a present obligation, contingent liability also have to disclose amount. No. It is the amount of probability. Existence, I don't have a doubt. Yes, sir. If it is contingent liability, amount I am asking. I am not talking about existence of obligation. Obligation is existing. So present obligation is the amount ka probability. Amount will be either 100 or 20. 50-50 and will take 100 only. Yeah? Whichever is higher. If it is 50. Okay. Average is expected value only. No? If you take average, that's expected value. Simple average. If it is 50-50, don't make it 50-50. My point is, how did you get probability? If somebody came and told you, probability is what? Inside feeling only, no? But 90, who told me, sir? And formula, the probability, if you determine a formula, you are God, sir. Then you will know what is the chance of your passing also, exact number. Probability cannot be computed. Probability can be assigned based on my insight. Movie rating 4 out of 5 or 3.5. Call that fellow, ask him to explain how he got 3.5, a 0.5, how did he get it? There's a computation for that. He's feeling it. Like that. Don't make it 50-50, make it 50.1 and 49.99. Do whatever you want. See, some accounting standards, some discretion will be there for us. You should know what is that, because that's how you earn money in real life. Next, provision ka reimbursement. I create a provision, but there is a third party who is agreeing to reimburse that. In that case, how to do? See, provision ka entry is generally puerile to provision for warranty. Examples. Because I write this entry, what will happen in my P&L account? You will find a posting like this. I gave warranty to my customer. For that, I created a liability of 100 lakhs in the current year. But the goods what I sold to my customer, I bought it from somebody else. I told that somebody else that in case I pay to this fellow, you are supposed to reimburse me. He said, yes, I will reimburse you. Standard says, if reimbursement is virtually certain, in that case only you can recognize a reimbursement income. Reimbursement income entry is what? Reimbursement receivable to reimbursement income, which is transferred to PRL. So by reimbursement, let's say the other party agreed to pay 70% of it, so 70. Sir, can I do a net presentation? Yes. Standard permits you to do a net presentation in P&L account. So instead of showing 100 and 70 separately, you can net off and show net 30. But what is wrong is, that means is 70 you can show here and present it as 30 on the face of P&L. But what is wrong is this. This is wrong. Creating net provision is wrong. 100 creates 70 records. Presentation will show it as 30. Directly creating 30 is wrong. Why? My obligation to the customer is 100. My right to recover is 70. If both correctly happens, then effectively your outflow is 30. But that is a different contract. This is a different contract. No, you cannot directly create 30. 100 separately you have to create, 70 separately you have to create. Net presentation you can do offsetting. This is permitted. On this MCQ is there. Sir, what if reimbursement is not virtually certain? If reimbursement is not virtually certain, it becomes a contingent asset. I may receive, I may not receive. If it is a contingent asset, you are not supposed to recognize it. Simply you have to give a disclosure if the receipt is probable. That's it. This entry you are writing means it should be virtually certain. Next. If the provision is long-term provision, that means the liability you have to pay much day in future. You have to create provision with present value. If time value of money is material, provision should be recognized at discounted value. This is one very big change compared to accounting standard 29. AS 29 also discounting of provision is not allowed. But in the Ind AS 37, time value of money accounting is there. Sir, in a legal case, I have to pay 1 lakh rupees to somebody after 10 years. I will pakka lose the case, but my lawyer is very talented fellow. He says that, sir, I can't make you win the case, but I will push the case beyond 10 years. Thank you, sir. Sir, I also know I committed. Then why did I hire a lawyer? I will anyway have to pay penalty. That fellow will push the case, drag it beyond 10 years. Now, I will create provision not for 1 lakh. Present value of 1,30,000 only I will create provision. Sir, but ultimately you have to pay 1 lakh. So what will happen? On this 30,000, every year you have to do unwinding of discount. Just like ACM. Every year interest cost to book, liability increase. Interest cost to book, liability increase. Keep on increasing. Then the nature and amount of obligation shall be reviewed at the end of each year. Last year I disclosed a contingent liability because it was a possible obligation. But in this 1 year, case developed. Today my lawyer is saying that, sir, last year I told that 30% chance. Today I feel that it is 75% chance that you will lose the case. Oh, last year whatever was possible obligation now became present obligation. Therefore, whatever is contingent liability last year will become a provision in the current year. Reverse also possible. Last year you created provision. This fellow says, sir, present obligation is not there. I will reverse the provision. I will start disclosing it as a contingent liability. Anything is possible. Amount lo changes also possible. Last year I created provision of 5 lakhs. This time I feel that liability will be 7 lakhs. So 2 lakhs extra provision I will create. Provision I will reduce depending on my estimate. Special cases. In this special cases, other questions usually will be from this. Onerous contract. What is the meaning of an onerous contract? Onerous and a word meaning is burdensome. Something you have entered thinking that it will be profitable, but after entering you realize that the contract is a loss for you. If you execute the contract, you will definitely suffer a loss. That kind of contract. But you can't avoid it. So loss you are not suffering now. Loss you will suffer in future. Sir, then why to suffer, sir? Get out of the contract. Not possible. So that kind of situation, you are forced to suffer a loss, obligated to suffer a loss. This kind of contracts are called as onerous contracts. The standard says if you execute the contract, whatever loss you are going to suffer, estimated to suffer, since a loss you cannot avoid, no, why to postpone it? Book the loss now, create a provision right now. With what amount? With the cost of executing the contract. Suppose you come and tell me, no sir, I am very smart. At the time of entering into a contract only, I also inserted a clause to exit out of the contract by paying a termination penalty to the other party. Now what you will do is, cost of executing the contract or penalty payable for terminating the contract, whichever is lower, amount to you have to create a provision. Because whatever is lower, that only people will do, no? So you will create a provision with a lower of cost of executing the cost of executing the contract means loss what you will suffer if you continue with this contract, or the penalty what you have to pay to get rid of this contract, whichever is lower. With that amount you have to create a provision. On these questions are there important stuff. Recent article also one question is, sir, do you agree that all provisions whatever you are creating and showing in your balance sheet today, they are likely to have outflow in future? They are likely to have outflow in future. If outflow chance is not there, I will not create provision. No, second condition will fail. Do you understand, sir? Provision if you are creating means outflow is likely to be there in future. But that does not mean that for every future outflow you will create provisions today. Provision ki future lo outflow will be there, but every future outflow ki you should not create a provisional. Simple example. I am in March month. March month salaries I paid, but I know that April also I will pay salaries. All these employees will be there in my company only. That does not mean that April month salary ki March only will create a provision. Why? What is missing there? April won't I pay salary? I will pay. Do I know the amount? Yes, sir. Why should I not create a provision in March month? What is missing there? Obligation is missing. I will pay salary in the month at the end of April after I receive service from the employee. As on 31st March, can any employee catch my collar and ask me, sir, give me salary April month? Can they demand? When will they get that right? Some event should happen. Which event? They giving services to. Without that past event which creates a obligation on your head, you should not create a provision. Provision creates and the present obligation is must. In this one question I will discuss with you guys. Sir, I have a ship. A ship, the moment it travels 3 years, it has to be brought back. You have to incur a very major overhaul expenditure. Estimated overall expenditure is 30 lakh rupees. Our ship just now started traveling. My accountant says, sir, anyway after 3 years we have to incur 30 lakh rupees. Each year, let me create a provision of 10 lakhs, 10 lakhs, 10 lakhs. Yes, sir. Is it right or wrong? Wrong. Why is it wrong? At time value of money, don't worry. If you want, I will discount and create. Other than time value of money. Other than time value of money. What is missing here? Forget about time value of money for a moment. Listen, the outflow, when are you going to incur? Future. But are you obligated to incur? So we can always sell the ship before 3 years. After 3 years of travel, when the ship comes back, I choose not to do this business. I simply put the ship for exhibition purposes. Small kids and all will come and play. Couples will take selfie and all. Titanic post. Adina job. That is my future plan with my ship. Or movie shootings and all, I will give it. Tell me, sir, will I incur that? At that case, no. That means what? The amount you may incur in future. I am not denying that. And most likely, in fact, 100% you are going to incur also, maybe. But are you obligated to incur? Obligation is not. So no matter how likely the outflow is, since obligation is missing in the first place, you will not recognize a provision. Clear, sir? So, no entry here, no entry here, no entry here. In case you incur this expenditure here, at that time, you will write to bank 30 lakhs, debit ship only overall cost. Which standard? PPE. Major inspection overall cost is capitalized to the cost of the exit. You understand, sir? Just because future outflow is certain, that does not mean that you will sit and create a provision. Now, obligation is very, very important. This is this one. Decommissioning liability already we discussed in PP, so I am not talking about it again. This is also one good case. Joint and several obligations. Sir, our company X Limited, along with 10 other companies, are staying in a special economic zone. Here, one river is there. All our industrial waste, we all put direct pipes. Successfully changed the color of the river. People who drank that water are behaving oddly these days, so people filed a case on that. Newly CM, very dynamic, acting, taking everything too seriously. He ordered a probe on this entire drama. They understood that we all people have successfully damaged the river. Ultimately, they have given us a penalty of rupees 500 crores on all the 10 companies put together. All 10 companies should combinedly pay 500 crores and they are jointly and severally liable. In this, I am also one company. Tell me, sir, should I create a provision or not? Don't even go that I did not. No, sir, you are caught. If you talk more, they will bring proofs also. So, you are caught. Okay? The present obligation is there. Outflow chance is there. Estimate, he is telling you, 500 crores for all 10 companies put together. Out of 10, I am one. Normally speaking, my share is how much? 500 divided by 10, 50. So, with a very heavy heart, PRL2 provision I create with an amount of 50 crores. I cried a lot, but ultimately okay. After 1 or 2, I got I accepted. Okay, 50 crores. We damaged the social responsibility. I paid 50. I slept. Suddenly got up. Something is haunting me. What is that? What if the other 9 companies don't pay? What if the other 9 companies don't pay? 450 crores also I only have to pay. No? But 450 crores, whether I have to pay or not, dependent on whether other companies will pay or not. That means it is an uncertain future event, not wholly within the control of the entities. Of 450 crores, you have to disclose it as a contingent liability. Your share of liability can create a provision, others share of liability you have to disclose a contingent liability when it is a joint and several obligation. Question old exam lo came, old AS exam lo came. India's exam never came, but it's a good case. ICAI has this question. Sir, before last 2 years exams, the consolidation questions you see, they are not there in any of the ICAI resources. You know from where they picked up? Old AS exam questions. That bonus shares adjustment, subsidiary, associate, parent, the combined balance sheet. All these are old CA final AS 21, AS 23 questions. Changed the names into Indias and asked of an exam. So ICAI has got lot of questions up their sleeve. They can bring anything, sir. So big standards we give importance. Small standards will save your day always. Last concept in India 37, that is restructuring provision. First of all, what is the meaning of restructuring? Restructuring means it is a program adopted by the management where we materially change the scope of our business. What is the meaning of scope of our business? I am earlier doing 3 businesses under the same company name. Now I shut down one business, I will do only 2 businesses. Or I was operating in 3 locations. One location I shut down, I am operating now only in 2 locations. This is change in the scope. Or there is a change in manner of conducting the business. Earlier I was having one main main shop in the center of the city and 10 retail stores in the entire district. All shops, physical sales. I shut down all the 10 shops. Only one main shop is there. Now I am actively there on Myntra, Ajio, e-commerce coaches. Earlier also I was selling goods. Now also I will selling goods. Earlier I was selling through my retail stores. Now I am selling online, e-commerce. That is a change in the manner of conducting the business. Either change in the scope or change in the way you conduct the business. This is called as restructuring. When any entity takes up a decision of restructuring, some consequent payments will be there. Imagine, sir, I am operating a factory in Kolkata. I want to shut down that factory. If I shut down that factory midway, do I have to compensate all the employees whom I am terminating from the jobs? Yes, I have to pay. Since I am closing my factory, I have to terminate the lease agreement with the lessor of the building. When I go to the lessor, what will he say? Arey, lease is still there for another 6 years. Why are you cancelling it? No, sorry, workers are troubling me. I want to shut down. Fine, shut down, pay penalty, termination penalty. Okay. Existing customers, I committed orders that I will deliver goods in future. Now I can't deliver. I called them, they shouted. And next day morning they sent letters with legal team. They are also asking damages. Okay. All that I should be prepared. Then only I will take the decision of restructuring. So because of your direct decision of restructuring, you have some consequent expenses. Standard says for all that expenses, you may have to create a provision. You have to create a provision. That's all. But here one small twist is restructuring. Are you doing on your own? Somebody asked you to legally do it. Generally, restructuring is a self-driven exercise. So the obligation, whatever you are having, is not a legal obligation. It is a constructive obligation. Now, what our standard is worried is a company which is having lot of profits in their P&L account, wantedly, artificially, on paper, create a restructuring exercise and create a huge restructuring provision, suppress their profit of current year, okay, and after some 3 or 4 years, when the business is not doing well, at that time they will simply pass one board resolution saying that we are withdrawing ourselves from restructuring activity, and therefore whatever restructure provision is there in the balance sheet, they will again release it to the credit of P&L account after 3 years. If I allow them to play like that, what will happen? Profit of current year is accounted and shown in 4th year. Are they not manipulating the profits? There is every chance that constructive obligations, so people will manipulate the profit. That too, restructuring, very huge amount. Standard does not want to take chance. What standard says is, this is a constructive obligation, I don't trust you unless you satisfy two conditions. Number one, there should be a detailed plan of restructuring. What is the meaning of detailed plan of restructuring? Because of your restructuring, which location is getting affected, how many employees are you removing, how much compensations are you paying, what is the time frame for completing this entire action. Atla a detailed formal plan of restructuring should be there. Number one. Second condition, e plan should be announced to all the affected parties. You should inform them. You should officially go and announce it, or you should at least start implementing the plan. If you announce it, what will happen, sir? Sir, tell me, any company can artificially create a plan. Paper hai kada, they can create a plan. They can approve the plan in board of directors meeting also. But can any company artificially go and fakely announce that we are shutting down a division? When you don't have a real intention of shutting down a division, can you go and tell your employees that company is going to close this division? If you go and tell, what will happen? Even before you close, employees will run away. Nobody will give you order. Are you understanding, sir? So you cannot lie about this fact. The standard wants you to announce this plan. The moment you announce this plan, then I will believe that you are having a constructive obligation. Now create provision. Are you understanding, sir? If these conditions are not there, people will go and manipulate the profits. When you are shutting down a division, let us say it will take another 6 months to shut down it completely. But I know that next 6 months we are going to suffer a loss in that division. That does not mean that a future loss you will create a provision now only. That is wrong. Why? Future losses, why should I create provisions, sir? Losses I am expected to suffer, not obligated to suffer. Obligated to suffer loss, that is onerous contract. Contract you cannot avoid. You have to execute it. Pakka loss, you create a provision. But this is not that. This is your own stupid business. You are closing down, but it will take time. Meanwhile, you will suffer loss. Next 6 months, you will suffer loss only. I know you will suffer a loss. You cannot create provision. Why? You are not obligated to suffer a loss. There is a difference between onerous contract custody and future operating loss custody. You should be careful. No provision. Sir, when I shut down a division, some assets I will sell now, sir, in future. Yes. On that assets gain also can come now. Yes. Can I recognize that gain now only? PPE standard will kick you if you do that. When can you recognize gain on disposal of assets? Only when they are actually disposed. That's all over. This is Indas 27. So revise this and you can solve. There are a lot of questions in study mat in this. In this, some good questions are there, sir. Very good questions are there. Okay, before we wind up the standard, suddenly I remember something. Follow this example. Sir, this is ocean. Sea. Our company got the license to extract oil from the base of the sea. So our Reliance Industries, what they did is, they now constructed piping from the sea floor to this structure what they constructed upside. This is called as oil rig. And through these pipes, they will extract the oil. Ship will come. In the ship they will load, ship will go away. Crude oil extraction, sir. Government gives permissions to companies like Reliance who are friends of government. The oil rig, when this fellow is constructing, government says that for construction of oil rig, you are damaging the floor of the sea. If you go and damage the floor of the sea, future oil extraction is not possible. Today you will nicely finish off your contract and run away. Tomorrow if you have to give the same contract to somebody, that fellow says, we cannot extract here. So government puts a condition that you have to incur restoration expenses to rectify the damage. This is an obligation what you have. Correctly understand. So our company, what they did is they estimated restoration cost. Let us say they estimated as 100 lakhs. They further estimated that in this 100 lakhs, 90 lakhs is to restore damage caused due to construction of oil rig, and 10 lakhs is to restore damages caused by extraction. You are drilling oil, no? Because of that also damage will happen. Our repair key, you have to spend 10 lakhs. For construction of this machinery equipment, because of that also damage happened, our rectification you have to spend 90 lakhs. Now, there are two questions in relation to this. One question is there in Indas 37, another question is there in Indas 2. Both the case is same, answers are different. Why they are different, you have to understand, correctly understand. Now, the first question is, by the end of current year 31st March, our company only has constructed this. Construction over. But extraction did not even start till now. Extraction did not start. Construction completed. Question is, should I create provision or not? If yes, for how much amount? 100, 90, 10, no provision. Sir, in the current year, did we construct the oil rig? The moment we constructed the oil rig, did you damage the sea floor? Since we damaged the sea floor, later on, after 5 years or after 10 years, I have an obligation to incur cost and restore the seabed to its normal level. Do I have that obligation? Pakka 100% you have to create a provision in the current year. So your entry will be what? Provision for decommission and restoration. With what amount? Actually, present value of 90 lakhs, because it is going to be incurred in future when I remove the oil rig. Debit where? Good. PPE, India 16. Do you understand this, sir? Sure. Okay. Yearly extraction did not start. Next year, extraction started. The moment extraction starts, do you have to create provision for the remaining amount also? Present value of debit where? Decommissioning liability will debit it to PP, sir? No. What you will debit to PP is which is directly attributable to construction of PP, that you can add it to PP. The construction or extraction? Extraction. So this is a cost of extracting crude oil, and crude oil is your inventory. So this is just like any other cost. P&L ki debit. And when you are measuring your inventory, a cost or NRV, whichever is lower you will apply, no? In that cost you should include this expenditure also. E question India 2 lo. E first entry question India 37, India 16. You understand, sir? Oil rig case is a very, very fantastic case, because the moment I say decommissioning cost or restoration cost, what is there in the mind of student is I will go and capitalize it correspondingly to PP. No, sir. Construction related cost you capitalize. Production related cost, how is it related to PP? Because you incurred this extra 10 lakhs cost, repairing the damage caused by production, extraction of the material, that is material related cost, not PP ka cost. So this 10 lakhs related extraction related damage cost is cost of inventory, not cost of the PP. Whereas construction related cost or decommissioning restoration cost incurred to repair the damage caused by construction, that is definitely PP related cost. Two questions separately are existing, but it's good, very, very good concept. Clear, sir? Understood? How we can close?